After another non-event from retail sales this morning, it seems as though the market does not want to budge whatsoever based on fundamental data. Now, do be mindful that we have the PPI numbers coming out tomorrow morning at 8:30, but the point of today's video is to evaluate the technical underpinnings of this overall uptrend and the new daily balance that's forming up here. So what do we see from a structural and price action perspective? Certainly an inside bar on today's session. Notice that on the bar-to-bar count, we've got ourselves a higher low, but also a lower high. This is always indicative of balance instead of trending activity. Trends want to break and expand over a prior high or break and expand underneath a prior low. Simply wasn't the case on today's session. What is noteworthy is that once again, we've defended the 410 area on the daily time frame chart, and we've also closed above the Monday and Tuesday settlements, which were fairly equal. So this does strike me as a step in the right direction for market bulls, but of course the objective is to achieve the equal high around 416.75, and from there threaten the break of this overall daily balance to close the overhead gap from 419.50 to 421.25. If you're a market bear at this point in time, you need to see a breakdown of 410. This level needs to break, and you need to get a lower high somewhere underneath 406.50, the rough lows from this area. If we have a look at the hourly time frame chart, we can see clear as day that in the morning session, there was an attempt to get some price action underneath SPY 410. It simply didn't stick, and from there, we develop a clean uptrend intraday back up towards the highs of the Tuesday session. So all things considered, it seems as though the bulls remain in the driver's seat, and once again, the objective on the daily chart is to achieve 416.75. You can clearly see now on the hourly time frame chart that the bears need a breakdown of 410, and they need to get a lower low underneath this area. We've slightly adjusted it down, 405.75. If we remain for a higher low above 405.75, then the daily balance area lives on, and the bulls have a chance once again to prove themselves for the equal high. If there's a lower high underneath 410 on the reattempt, something that would look like this, much more of a neutral trend on your daily time frame chart, we would start to be more cautious about bullish outcomes going forward. Overall, the market internals would reinforce the idea of cautious optimism, noting that the inflows for the week have been slightly lackluster, not making those 300 million reads, but they are net positive overall. And note that the advanced decline line does open up fairly negative. It recaptures the zero line here after a higher low, but it's not like we were spending Tuesday or even today's session up above in trend higher zone above 1500. So it leaves a bit to be desired from the bullish perspective, but it's certainly not bearish, hanging out sideways down here stuck in trend lower zone. The same thing holds true for the ticks. Strong reads on the Monday session, as we pointed out last night, but lackluster build on Tuesday and lackluster build on today's session, even though we did actually have a solid intraday uptrend. So overall, the underpinnings of the market are technically bullish, but to what degree? I wouldn't be going out there and gunning for new highs, going all in with big positions. I think cautious optimism is what we're learning from the market internals. The market profile also suggests being cautiously optimistic, noting that the value area here is completely contained within the Tuesday value, and the point of control is almost even, slightly higher on today's session. It did not close towards the highs of today's trading range, even though the settlement was at the highs of the day's trading range. So once again, cautious optimism here. We've got decent excess at the highs, 3 ticks here, and only 1 tick of excess at the lows, although the volume taper is significant there. If we were to come back down and clean it up, it would be well within reason, but it's not so much of a poor low that I would say that the market must revisit this area. What I do find interesting from the profile perspective is that we've closed right here around the spike. It's not technically a spike because it did not happen in M period, but the single prints from B period in the Tuesday session. Once again, remember that this roughly 41.59, 41.58 area in our ES futures should offer up a little bit of resistance. And then on a break of that level, remember that this represents thin structure. We could move through that sooner rather than later. Having a look at the weekly performance of our S&P sectors reveals that we are still seeing risk on posture, with consumer discretionary leading the pack up 3.89%, followed by infotech up 2.24%, and then communications, big rebound, up 1.88%. At the bottom of the barrel, we're seeing the XLE for energy down 1.42%, XLV for healthcare down 0.28%, and real estate here down 0.22%. Overall, once again, this speaks to risk on posturing and risk off lagging the market. If we check in on the structural charts, notice that the XLY did confirm and hold this higher low off of 148. It's made the rebound up towards this significant area at 154.50. And now, once again, I would not be surprised to either see a pullback and then break after a meaningful intraday higher low here, or even a daily higher low. I think that that would be reasonable considering the large upper wick from the initial gap fill candle here. Now, if we break and continue up to these highs, that would be even more bullish, producing an equal high. But as of right now, because we do have a higher low in place and we're defending the daily 200 SMA, I would say that this chart is certainly more bullish than bearish from a structural perspective, meaningful being such a heavyweight risk-on sector. XLK for the tech sector is up next, and you'll certainly note that we are still in the daily balance area here. The breakout level is over 144, comes up to close the gap from 146 up to 147.85. Obviously bullish pressure for your S&P 500, and that would technically align nicely with a range double, which is always what we're looking at when we break a daily balance. If we move back down to the bottom end of the range, it's still neutral from a structural perspective, but intra-week would of course provide some drag to the S&Ps. You want to see 139.25 hold going forward. Let's have a look at the XLC for communications. It is finding a higher low above 54.30, the prior structure from here. What we want to see happen is, of course, a recapture of 57.30 with a higher low above. The threat to communications right now is that we find a daily lower high underneath 57.30 and then roll back over for a retest of 54.30. That would be a concern and certainly bearish pressure intra-week for the S&P 500, but really, in the grand scheme of things from a weekly or even monthly time frame chart perspective, any weekly higher lows above 52.17 would still be reasonable on this particular chart. As of right now, the daily chart closing above the prior two pivot highs here does strike me as more bullish than bearish, so we are watching intra-week for the rotation to retest 57.30. Strikes me as bullish pressure for your S&P 500. XLI for industrials starting to break the top of this overall range after a beautiful set and series of daily higher lows. 103 more confirmation and time spent above. The target's 105.25. Bullish pressure for your S&Ps. XLB for materials still stuck sideways in this range, roughly around the midpoint, just a hair higher than the midpoint. It will become meaningful when and if it breaks 84.25 to the upside, and bearish pressure, of course, underneath 80.75. The pattern so far would suggest more upside in materials, lightweight sector there. XLU for utilities is D for defensive. It's continuing to go sideways in this lower range here, and it really doesn't strike me as a big deal for markets, remembering that this wants to lag. It's certainly still producing lower highs on the daily time frame chart. We don't want it falling off of a cliff, which it's not doing. So far, no issues with utilities. Next up are financials. Notice that we do get a little bit of a green rebound on today's session, but not nearly closing up and over the settling price from Monday like the S&P itself. Continue to monitor breakouts over 37 for bullish pressure for markets, or underneath 36, certainly starting to become more of a cause for concern. As we rotate through these sectors, I think it becomes quite clear why the S&P isn't really going anywhere. XLP for consumer staples, D for defensive in nature, starting to hold this daily double bottom. The threat, of course, is a move over the neckline at 74 to start another leg higher. Of course, upward pressure is still upward pressure for our markets, but remembering that this is D for defensive, we don't necessarily want it leading the way. Currently doesn't look to be a threat from a risk-off posture perspective. Next up is energy, pulling back, finding a daily hammer candle off of the midpoint of the range, around 87.50s. As long as this is towards the midpoint of the overall range, once again, it does not strike me as a concern from a defensive perspective. If we start breaking out over 93.25, and that's what's leading the next leg higher in the market, that starts to become a concern. XLV really not going anywhere still. This has been the most lackluster movement I think I've ever seen out of the healthcare sector, breaking the wedge but falling right back down into the wedge. On today's session, we have a really compressed range here, really not doing anything impressive whatsoever. This is the second heaviest weighted sector for the market by market cap, so we do want to see it participating in upside rallies if they're going to be deemed strong in the S&P 500. And as of right now, just because we're not getting meaningful breakdown, I would say that this is okay. We know it's D for defensive from a posturing perspective, but once again, can't really afford to have this one fall off of a cliff. I would continue to monitor 130.50 as your key level in healthcare. Last but certainly not least, we have the XLRE for real estate going sideways, holding up as a prior area of resistance, 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 newfound support, support, and support. Much more to do with the wealth effect. This strikes me as neutral for the S&P. It'll be a bullish force if we start making aggressive highs over roughly 41.50, and really only a bearish pressure underneath 37.25. Not concerned with real estate right now. The ratio grid as well strikes me as being neutral to optimistic about outcomes in our market. The top four are the risk-on sectors. Clear outperformance from the tech sector here. Heaviest weight sector strikes me as bullish. Notice, though, that the XLV is right back down towards this double bottom. Not really a great look from the second heaviest weighted sector of the market. The XLF, as it remains stuck in the daily balance area, is certainly not breaking this resistance trendline in the ratio, but the XLY is breaking out of its bull flag here. So once again, risk on is mostly there, but some concerns in healthcare, and XLF really needs to do something from the structural chart perspective to get in gear on the ratio. If we look at the bottom four sectors, the risk off sectors, notice that most of them are still continuing in their overall downtrends. The XLE did find a lower high underneath the 50 SMA, so that strikes me as meaningful. And real estate as well, mostly sideways, having much more to do with our wealth effect. If we take a look specifically at growth versus value, so XLY divided by XLP, just like the XLY chart itself, it's starting to break this bull flag, certainly found a meaningful higher low above the gray zone, which was the prior double bottom from here, and where we really found a meaningful lower high before breaking down underneath this area for the final little leg lower here in market. So this does strike me as being more risk on versus risk off. Once again, from a posturing perspective, I think we're more risk on than risk off, but again, cautiously optimistic about outcomes in this market here. Having a look at the dollar, notice that we're starting to break out of the bull flag, which is one of the causes for concerns that we've been bringing up in multiple instances now. If we can get a higher high over 105, it should of course start to put some downward pressure on markets. That relationship isn't so clear here on today's daily bars, but if we take a look at the gold chart, remember that there is still some room to fall in the downward direction, of course indicating that the dollar could move higher. So if the gold chart breaks down underneath 1780, the lows from in this area here, that might be where the market actually starts to catch a little bit of a downdraft from the pressure of the dollar. Let's quickly have a look at rates. Again, continuing to climb in the upward direction. Really interesting how resilient the market is considering a higher rate environment here as we're coming into test 3880 in our TNX. Once again, doesn't seem to me that this would be a comfortable move for the tech sector specifically, which drives so much growth in our S&P 500. So really keeping an eye on what's going on here with 3880 in the TNX. Considering the hawkish nature of the data we've been receiving from a fundamental perspective, it makes sense to me that the probabilities of a 25 basis point rate hike have been reduced ever so slightly, and the market is starting to price in more of a chance for a 50 basis point rate hike. And that's really speaking to the fact that the market's concerned less about inflation right now and much more about how the consumer is actually doing and avoiding a recession. If we look at the retail sales numbers here, everything is extremely positive barring electronics and appliance stores. Notice that food services and drinking places was up 25.2%. That's an incredible read on a month-over-month revision, speaking to the strength and resiliency of the consumer. Once again, the market's less concerned about inflation, more concerned about avoiding a potential recession. And we can sort of, prove that because the market was green on today's session. Even though these numbers would speak to the possibility of inflation rebounding, the market didn't seem to care. It seems to think that avoiding a recession is more noteworthy, and preserving earnings per share, seeing consumers spending and driving up the earnings of companies is much more healthy for the market environment and achieving the soft landing that Jerome Powell continues to speak about. We'll make note that good news is good news and bad news is bad news. So as of right now for tomorrow's session, Be mindful that if PPI comes in hot, I don't imagine that that goes too well for our markets. If it comes in at the expectations, I think we get another lackluster day where we need to break a technical area for the next move to unfold. Having a look at some of our risk appetite charts, we'll notice that the TLT bonds are underperforming equities, which speaks to a comfortable amount of risk taking in equities and currently no flight to safety trade underway. Having a look at the HYG, we can see a bit of a negative divergence between smart money and dumb money, so to speak, speaking to the cautionary tales we've been saying about being cautiously optimistic on this market for bullish outcomes. What does strike me as important, though, is what happened in Bitcoin today, noting that the prior breakdown highs, which once acted as resistance here, are now acting as support. Really solid breakout off of that 21,500 hold, which strikes me as being optimistic for bullish outcomes in equities. From an overall risk-taking perspective, this certainly speaks to better than expected outcomes in the S&P 500. Let's have a look through some of our breadth-related charts. Notice that the new highs versus lows is picking back up and staying above the zero mark. Once again, we want to avoid a look like this and morph into a look that looks like this. Certainly speaks to improved bullish odds as we move forward. Having a look at the stocks over their 200 SMA in the S&P 500, hanging out above the 50% mark, speaks to bullish odds and just general improvements in the market, seeing that the higher lows are holding and we are still experiencing a higher high at this point in time. Stocks over their 50 simple moving average remaining elevated, but certainly not up above in the contrarian zone. Once again, strikes me as very healthy for bullish and optimistic outcomes here in our S&P 500. Next up, we'll have a look at the equal weight S&P 500 versus the weighted, and notice the beautiful prior resistance, prior resistance, prior resistance turns into newfound support. Once again, it speaks to the underpinnings of the market probably being stronger than we may have imagined. Even if we look at the weighted S&P, we still have very much so prior resistance, resistance, resistance turning into support, but notice the slight undercut in the weighted S&P versus the unweighted. Once again, this speaks to improved bullish breadth in the underpinnings of the market. We're not so concerned with a couple of bad apples weighing down on our S&P 500. Next up, if we have a look at the Dow divergence that we've been discussing, what I find most interesting about this is that we have the breakout and we've turned for a significant higher low above the breakout level. So at this point in time, if the market is going to confirm the overall bullish nature of the move, really it's up to industrials to break out of this pattern and start to find new higher highs. Given the fact that industrials have been putting in consecutive higher lows and we formed inside bar hammers over the past two previous sessions, I would think that we have an opportunity at least for some bullish outcomes here, which would speak to confirmation for our S&P rally. Having a quick look at volatility, we'll note very similar things to what we pointed out yesterday. Strong move underneath 2050, speaking to the fact that the market is quite content with this bottom and this as a reasonable higher low in the overall structure. Having a look at the VVIX, once again, we'll notice that it is aggressively coming in. So someone made their hedged bet. It did not guarantee a downside outcome in the market. And as of right now, this is coming back down into complacency zone where we know that the market is more comfortable finding bullish outcomes. Having a look at our volatility futures, which have been updated to reflect the March and April contracts, notice that they are continuing into Contango. 9-day versus 30-day VIX is continuing into Contango. Once again, speaking to the expectation that bullish odds can be improved. Money managers are happy to allocate capital in the present day versus waiting for volatility to settle down and at some point in the future, right? So this does speak to improved odds for bullish outcomes in our markets. They're fairly content with the bullish structure underneath us. Rounding out our broad market with the QQQ and IWM, of course, notice that we did hold the higher low. We're looking for improved outcomes up and over the top of this balance area here, which is at 311.75. Intraday, of course, we do have to get there in the first place, but when and if that breaks to the upside, your target will ultimately become 320.50. For bears, it's got to be a breakdown of 302.75 and then even a lower high underneath 302.75, the prior resistance, which then turned into support here. I'm giving bears the benefit of the Dow underneath 302.75 just because we've come off the upper edge of the weekly expected move. From a more structural perspective, you would want to see a lower high underneath the low of this indecisive doji here to really be the nail in the coffin to reverse the trend in the downward direction. You could start to think of that as a potential double top breakdown of the neckline, but into the remainder of the week, there may be some bearish outcomes underneath 302.75. That would be the level that I carry forward. Let's have a look at the IWM. Beautiful hold once again of that 188.90 level, closing above the Tuesday high. We do still have to contend with 196 as resistance, and remember that the concern from this perspective is that we do have resistance from these multiple interactions, and if we roll over off of that, there's the opportunity for a daily lower high, and then a breakdown of this level, of course, would be concerning to start a new daily downtrend. So really watching and monitoring that pattern here inside of small caps. The pivotal level, once again, is 196. So moving through our core list of companies quite rapidly, notice that Apple did take out the resistance area around 154, and now it's just all about monitoring for the break of 156.50. From there, you'll notice some thin structure off to the left. Our next overhead target is 163.75. If we fall back down underneath 154, I would treat it as neutral in this range, and overall start to think of this as the potential for a weekly bull flag. As long as this gap remains in place and that's holding, bullish structure here inside of Apple. Next up is Netflix. This strikes me as being one that, probably has lower odds of being playable into the remainder of the week. If we do get a break of the two equal highs, we're just going to revisit 368.50, and there's still the opportunity for a daily lower high up against that level. Also, if you think about this as a range, we're just stuck range bound, right? The more meaningful break to the upside is getting acceptance above 368.50. We have not experienced a daily close above that level yet. Bears, of course, want to see breakdowns of these equal lows right around 349.65. Next up is going to be Tesla. What do we see on Tesla? Nice hammer candle on today's session, setting up a breakout point at 213. If that goes, the target overhead is 227 or the daily 200 SMA at 225 roughly. If we have a look at the hourly time frame chart, notice the great break retest of the prior resistance area here. We talked about this structure in the weekly watch list episode last week, right? And now we're setting up a very similar pattern with these equal highs at 213. Higher lows along the way, higher lows, watching for that break. Now, once again, everybody and their sister is watching this. So if everybody gets long and then the breakout fails underneath 213, please have a stop loss underneath that level, because you can imagine that there will be everybody rushing to the exits, and you might get something that looks like this to retest this area and this breakout area at 202.25. So still bullish in the medium term if we hold 202.25, but don't get caught up in the nasty pullback if the breakout fails around 213. So please use a responsible stop loss on Tesla. Next up is Google. If you listened into last night's episode, we talked about breaking out over the high of the prior day's hammer candle. It's exactly what took place on today's session. Good follow through over 95, watching for continuation into 99.50, and then flipping to a bear. Remember that this has the strong opportunity for a daily head and shoulders pattern to find a lower high off of 99.50, so I would keep that in mind as we move forward into the remainder of the week. Next up is Meta. This is an hourly time frame chart, and I just want to point out how lackluster the price action is here. Very, very sideways and still getting acceptance into the gap underneath us. This would not be a priority to trade into the remainder of this week. Next up is NVIDIA. NVIDIA is a great trade to potentially watch into the remainder of the week for a break over 229. Just a very beautiful 3-bar play setting up. 1, 2, and then 3 gets follow through over the 2 equal highs. We've got an inside bar hammer in the upper 50% of the range, coinciding nicely with prior resistance as well. On a break of that, the daily structure overhead to start paying attention to is 250, 250. Plenty of range to trade for the upside. Could we be seeing a pre-earnings run-up? Absolutely. If we break down underneath 217.50, I would just let it simmer sideways and potentially build out a weekly bull flag. Here we go with Microsoft. We talked about this as a setup yesterday as well, and the setup's still in play if we can get the break and acceptance over 274. Hasn't happened yet, but notice that we looked into the gap underneath us at 267, a little bit of lower wick in there on today's session, and where do we close? fairly strong, up towards the lower edge of the upper third of today's range. Strikes me as more bullish than bearish. The breakout trade over 274 is still on the table. It would start to become off the table when and if we start closing this gap underneath us, getting price acceptance towards 260. Next up, we have Amazon, and notice that Amazon is still technically trying to find a head and shoulders formation. Not really enthused about trading Amazon into the remainder of the week. I think Tesla looks much better. I think the, NVIDIA chart that we just saw looks much better. Those would be the primary focus. Amazon definitely falls lower in the overall list. Honorable mentions for the end of today's video, very similar to NVIDIA. Of course, all of these are chip-making companies. AMZN is up first. Advanced Micro Devices, 3-bar play setting up just like NVIDIA. Your breakout level is over 86, target 89. Next up, we have MU, Micron Technologies, over 62 on the 3-bar play, target 64.50. Next up, we have Marvell Technology, another chip-making stock. You can see the pattern here, very similar. All of these are 3-bar plays. If we take out the hammer high, 47, look to target the equal high, 49.50. So there's a stock with this setup at almost every price point. The one that I would favor, though, and I saved the best for last, is ON Semiconductor, and the reason being is look at the prior strength here. 3-bar play, it's not even a hammer candle, it's a solid green-bodied bar inside of the green bar prior, and if this breaks over 87.15, we're headed to all-time highs. So blue sky territory is up above, no technical resistance to run into. It just seems to me that this would be one of the ones to trade on this particular pattern following through for tomorrow's session. That's going to round out today's episode of the Midweek Market Update. If you enjoyed it or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. And as always, I wish you all a green trading week.